Are global banks dangerously overexposed to shadow banks who are at risk of a recession? I've talked before about these extreme financial measures and the warnings that they've been sending, and one of those is credit default swaps. And credit default swaps single out the banking sector. So there may be rising concerns over the banking sector's exposure to shadow banks and something called private credit. Shadow banks, despite the name, they're easy enough to understand. They're lenders who are not official banking entities. Things like investment funds that are set up to make loans. But because they're not banks, this leads to some, let's call them complications. One of those is who shadow banks tend to lend to. Now, actual banks, they have the highest quality borrowers covered. In fact, since they've been highly risk averse ever since August 9th of 2007, top quality debt is basically all they've been doing. But this has left riskier borrowers without nearly enough access to credit. And that's where these shadow banks have come in. Being able to take risks regulated banks just won't. Now, while on its own this is a positive, serving a desperately underserved and critical part of the economy, you can already see where this is going if shadow banks are almost entirely exposed to the riskiest classes of borrowers. As it turns out, since banks are also one key source of funds for shadow banks, especially the past couple years, that means regulated banks are also fairly heavily exposed to these shadow banks. And all of this revolves around the macro question. Worsening conditions in the economy will stress shadow banks in a way they've not yet experienced. In fact, not only do we have reports of shadow bank investors getting cold feet, there are also reports filtering in from shorts that are circling the shadow banking sector, sensing an opportunity as macro conditions worsen. And if they do for the shadow banking sector, what might happen to the traditional banking sector and then everything beyond? Might that account for these extreme levels that we're seeing in all of these financial indications, from the gold ratios to the Swiss franc or the Hong Kong dollar, swap spreads that continue to be incredibly low, and the credit default swaps that I talked about in yesterday's video? It just might account for why there's so much anxiety in the marketplace when you've got a combination of deflationary monetary conditions and growing serious questions about the economic trajectory from here on out for the rest of the year. But we're going to start with the sharks that are circling the shadow bank space. This is a report that came out on Saturday. Hedge funds are betting that trade wars, a shrinking economy, and rising strain among borrowers will begin to hit private credit in the US. So far, that gamble's paying off. Short sellers have made about $1.7 billion on paper so far this year from wagers against 7 of the biggest direct lenders, including Apollo, Ares, and Blue Owl Capital, at least according to data that was compiled by S3 Partners. Alternative asset managers are, quote, very exposed if we do have a recession. If company revenue falls, cash flow falls, which means leverage goes up and free cash flow goes out the window, according to Scott Roberts, who's a senior managing partner at Belvedere Direct Lending Advisors. And these loans, keep in mind as we go through here, these loans don't have a market. So not only are they illiquid, we also have no idea how many are actually performing or at what possible losses there might be, what possible ways that these shadow lenders have to alleviate the strains that they might be experiencing under these macroeconomic conditions that are indeed deteriorating. But back to the article. There's substantial evidence that suggests direct lenders, through optimism and or self-interest, are camouflaging problem loans, postponing defaults and bankruptcies, leading to potential overstatement of loan valuations, portfolio yields, and fund returns. That's what Jeffrey Deal and Bill Sacker of Adams Street said, which is a firm that manages $62 billion of assets, and they put this in a report that came out last week. So what we're talking about here, these shadow banks and private credit, is essentially this part of the financial system that arose in the wake of the 2008 crisis because it wasn't subprime mortgages, it wasn't a recession, it was a monetary breakdown that started with the banking sector. Banks never recovered from 2008, and because of that, it has left the economy underserved as far as credit and recirculation of money through credit has been concerned, especially the riskiest class of borrowers. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store of value hedge for years. In fact, it's the ultimate error hedge. But if all you're doing is owning gold, you're only preserving your wealth, not growing it. And that's where today's video sponsor, Monetary Metals, comes in. With Monetary Metals, you can earn up to 4% in their leasing program immediately upon funding your account. And there are higher yields available to accredited investors in their bond offerings. The interest that you earn on your physical metal is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver while you hold them. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. Traditional regulated banks cutting back have been impaired in their balance sheets, which has meant they stick to the safest and most liquid opportunities, lending opportunities. They don't want to lend to riskier people because they can't afford to. They don't see the risk-adjusted returns that make it worthwhile spending the scarce balance sheet capacity that they have in those areas. It's better just to buy treasuries and lend to Google or Alphabet, whatever it's called these days. Instead, shadow banks have arisen to take over part of that role, to fill in some of that gap, to be the risk takers in the financial system, to open up some balance sheet capacity separated from those impaired large banks. And as far as this direct lending is concerned, direct lending started with something like private equity. But essentially, it's just these outside of the banking sector, these private balance sheets that have been taking on different types of debt to private companies for a long period of time, which means these private equity type firms know where to find the funding. So naturally, they started doing more than straight up private equity. If there's a need in the private marketplace for credit recirculation, and these people know where to get credit and where to get funding and just have an opportunity to redistribute it, they've naturally grown into that role. So when we're talking about direct lending through these shadow banks, what we're really talking about is the shadow banks find the cash in various different places. They then re-lend it and sit on the loans themselves. So things like buy now, pay later that have a shadow bank direct lending behind them, that's simply all they are. They're trying to fill in the gap that's left behind by an impaired banking system, in doing so by redistributing money and credit from where it sits to where it might be better put to use, with the question mark on if it's better put to use in these capacities. Now, strictly speaking, it is better to be, we need that type of redistribution. We need that type of risk taking. The problem is whether or not it's gone too far and whether or not the system has the capabilities to handle going too far and experiencing something like a recession condition, full-blown recession conditions beyond the forgot how to grow style. One of the reasons that this private form of credit direct lending has taken off so much is because the returns are bigger, because they can charge premiums for these underserved parts of the economy that have been started for credit since 2008. So the funds that they attract are essentially locked up. Investors are prevented from withdrawing them, making their investments illiquid and difficult to manage. That's where these shadow banks find funding. They go into the marketplace, they find wealthy investors or cash-rich institutions and some banks as well, and they get their funding and leverage from these places and then place those funds, re-lending it, recirculating it to those in the real economy that might get it but can't get it from any other source. In this part of the marketplace, these non-traditional forms like private credit really took off after 2008. Though in the immediate aftermath of the crisis, it was mostly about high yield and junk bonds because the bond market was the one sector of the credit system that was still functioning, as the banking part of it was completely shut down for a long period of time. So initially, for all these underserved parts of the system, borrowers could turn to high yield bonds and leverage loans and things like that, but only up until around 2014. Since a lot of those borrowers were in the energy space, the 2014-2015 Eurodollar #3 oil crash. And so the high-yield junk bond market took a big step back in the middle part of the 2010s. But in came leveraged loans and private credit to make up the shortfall in one area that was trying to make up the previous shortfall from the banking sector. So private credit really started to take off around 2015, but it really accelerated over the last couple of years after the volatility in high-yield junk bonds in 2022, along with leveraged loans. Private credit really experienced a massive boom since 2022 over the last several years. The forgot how to grow economy, this has been one of the supports, keeping it to nothing more than, or nothing worse than forgot how to grow. But we have to keep in mind, these shadow banks that are involved in private credit and a whole bunch of other activities like the basis trade, they aren't really banks. They can't create money. They don't have the bookkeeper's pen, meaning they do have to borrow themselves. And like I said before, they're funded by some equity investors from cash-rich sources, private individuals as well as institutions, and then they redirect that leverage into a whole bunch of other places, and that's really the fear here. Because some of that leverage does come from the regulated banking sector, because regulated banks are seeing all the fun and all the money being made over here in private credit and thinking we want to get back in on some of that, but without taking the direct risk of lending ourselves. Let's go through these shadow banks and at least keep it at what seems to be at an arm's length. But you can already see the potential problems here. All of this stuff has been done, like we talked about in the CLO market and Japanese investors. All of this has been done on the premise of strong and resilient soft landing. It's okay to lend funds into the underserved parts of the market, the riskier parts of the economy, because in their soft landing, strong and resilient, there's really no downside here. But just like we saw with credit spreads being compressed down to near historic levels, historic lows, that kind of complacency very likely found its way into private credit, with private credit absolutely booming over the last several years. That's direct lending. And direct lending on those assumptions to the riskier parts of the economy, that's not going to hold up very well if both of those assumptions, even if one of those assumptions proves to be wrong. If the economy doesn't hold up, it isn't strong and resilient, and more than that, the funding environment becomes shaky, unpredictable, even deflationary. By deflationary, we mean the interruption in the free flow of money and credit through the system, which is exactly what we saw in a big way last month. So you put questionable monetary conditions, liquidity, together with rising concerns over the economy that challenges these assumptions that underpinned the private credit boom over the last couple of years. Not only do we have to look at shadow banks, we also have to look at who shadow banks are impacting and where that could potentially spill over. And the regulated banking system has a whole lot of exposure to the shadow banks, a lot of new exposures under these other assumptions, the soft landing assumptions of the last couple of years. And so in April, just last month, the IMF in its latest global financial stability report said, as we move into new analysis in this April 2025 GFSR, we highlight the growing role of non-bank financial intermediation and the increased exposure of banks to non-bank financial intermediation. Non-bank financial institutions cover a broad array of intermediation activity, including insurance companies, pension funds, investment funds, and finance companies. There's a whole bunch of these shadow banks. The linkage between banks and non-banks have been growing, increasing the NBFI's influence on system-wide financial stability, especially under potential deflationary and recession conditions. Economic downturns that put pressure on private credit borrower firms' credit quality could lead to losses in the banking sector. Private credit funds rely on various types of financing to generate leverage returns and to manage their liquidity needs, including subscription credit facilities and asset-based lending provided by international bank syndications and collateralized with middle market loans, which means collateral and spreading that all throughout the system. Large foreign banks play a crucial role in financing the U.S. private credit ecosystem. The identified portion of bank exposures to private credit vehicles globally exceeds $500 billion, at least according to Moody's, and it's likely more than that. And total bank exposure likely exceeds 25% of total assets under management in private credit funds. So like I said, regulated banks have been sensing the opportunity of being able to get back into higher return assets, but also keeping it at arm's length, have been lending heavily to the space, lending heavily to shadow banks over the last several years, convinced or at least hoping that the economic conditions and economic climate would work out the way that Jay Powell and everyone else has said. Soft landing, no recession risk, don't have to worry about these risky borrowers who are being lent to by these shadow banks who banks are lending to, therefore indirectly exposed to all of it going in the wrong direction. So given all that, you would think that if there are risks here, what we would see is those risks start to pile up among the shadow banks before then becoming an issue for the banking sector. And because this is all shadows, it's deep inside the Eurodollar system, we don't have a whole lot of information, but we have been getting some information filtering out more recently, especially as these economic questions and the deflationary circumstances have brought them back to the forefront. Starting with what I talked about in yesterday's video on credit default swaps. First of all, the credit default swap market is saying, we see something with the banking system. I know credit default swaps on U.S. government debt doesn't seem like it's about the banking sector, but as I went through in that video, and I highly recommend you check that out, as I went through in that video, credit default swaps on U.S. government debt is really a source of information on perceived risk about the banking sector and specifically the banking sector. So you've got the credit default swap market that already is flashing a warning sign. The most it has flashed since March and April and May of 2023, the last banking crisis that we experienced. So already there's a warning there. Plus, I also talked about how Oaktree is singling out that some private credit investors are starting to feel the pinch or feel the possibility of losses rising in that space, and therefore seeking to sell their illiquid positions, their illiquid investments in shadow banks, because they don't want to stick around to find out whether or not any of this is true or false. They'd rather sell at a discount to reduce their own exposure in the face of rising potential negatives all across the economy as well as the monetary system. And then on top of that, the report that I mentioned in the start of this video, which is that short sellers are sensing the same thing where it comes to shadow bank. So if we're looking at this from a process standpoint, like I said, you would expect if there's an issue, it would start with concerns over shadow banks that are not just expressed in terms of words and filling mainstream news articles, but instead expressed in actual activity, sales, getting out of the space. That would be the first warning sign that it could potentially go farther beyond shadow banks, assuming it does continue to go in this direction. Now comes the potential exposures to the regulated banking sector. And that's where the data shows there is a lot of exposure to them. Using the Federal Reserve's H8 statistics, what you see is that loans to non-depository financial institutions, which are these investment funds, these shadow banks that we're talking about, and just to point out here, in this broad category from the Fed, it means all types of shadow banks, not specifically private credit. But it doesn't really matter at this point, because if there's a problem in specifically private credit that would impact shadow banks, it's going to impact all forms of shadow banks and everything that they're doing. So this is basically a measure of exposure from the regulated banking sector to shadow banks. And what we've seen is that since Silicon Valley Bank, at least according to these stats, have grown by $346 billion to a total of $1.26 trillion. So that is a pretty substantial exposure by U.S. regulated banks to all of these shadow banks. That's a 38% increase, which goes to show exactly what I just said. The banking sector, after SVB, said, yeah, we're done. We're going to wash our hands with this economy and this system. We'll let other parts of the financial system take the risk and see where this goes. Because meanwhile, at the same time, ever since SVB, loans from the regulated banking sector to the rest of the economy, the rest of anything, have only increased by 2.9%. 2.9% total, not per year, total in a little over 2 years since SVB. But also, they've been increasingly worried about all of this stuff coming down in 2024 and in 2025. Because while they're lending to shadow banks and not lending directly to the real economy, U.S. banks have been buying tons and tons of government bonds, especially U.S. treasuries. Their increase in treasury holdings, not including MBS here, their increase in treasury and agency holdings has soared by 15% since Silicon Valley Bank, or around $236 billion. But $221 billion of that has been added since May of last year. So the banking sector, while they're still lending to shadow banks, have also been building their treasury cushion just in case. And they've been doing it more aggressively, certainly over the last month, given all the conditions of the deflationary outcomes and the rising recession questions that go along with it. And this is the same behavior that I've pointed out and we've talked about before that we've seen and documented from European banks. They've done exactly the same things at exactly the same time, which goes to show what I said in the introduction. This is a global thing, not strictly a U.S. thing or a U.S. bank thing. Loans to what Europe calls non-monetary financial institutions, or the same thing as we just talked about, banks lending to shadow banks. So European banks lending to European shadow banks in euros has increased by 16% since August of 2023. That's an increase of 200 billion, a little more than 200 billion euros in loans to these shadow banks. Just like with US banks, European banks aren't lending to anyone else. Loans to everyone else, including the real economy, have only increased by 174 billion in that same time frame. Yet, just like US banks, and even more aggressively than US banks, European firms, regulated firms, have been piling up government bonds as a just in case. And for the European banks, their piling on government bonds has been near historic in the first quarter of this year, trying to build a liquidity as well as a safety buffer on their balance sheets because they're exposed to not just recessionary conditions across the economy, full-blown worst-case recessionary conditions. They're also exposed to indirectly to the credit risk of these shadow banks, to which both U.S. and American banks have been lending to over the last couple of years of forgot how to grow economics. So we start with all of these financial signals that are flashing substantial warnings. Gold to silver, copper to gold, real deflationary stuff. Swap spreads. Swap spreads are really negative here. And now credit default swap. The credit default swap on U.S. sovereign debt is a bank sector stress indicator. And it's flashing the most consistent warning, the highest warning since the bank crisis in 2023. So we have to ask why. And so the CDS market looks at, okay, short sellers are starting to circle around private credit lenders. And we got Oaktree saying that private credit investors are getting cold feet. They're not panicking, but like short sellers, they're smelling trouble ahead. And we know that the banking sector is heavily exposed to these shadow banks. While we don't have any idea what the shape and the condition of all this shadow debt and private credit among the shadow banks really is, we do know with some reasonable suspicion here that a turn in the real economy plus deflationary conditions is not going to play out well in that area. So when you have recession plus deflationary conditions that can really tighten the screws on everything, the uncertainty, at the very least, to use that term, is enormous. Now, like I said yesterday, it doesn't necessarily mean that 2008 is repeating or that a crash is imminent in the space or anywhere else at this point. What we're seeing is rising risks that something could potentially happen. There's a lot of alarming concern that there really is something to be concerned about here. The data shows, and these linkages really demonstrate that we definitely need to continue to pay close attention to them, and that the chances the forgot how to grow world really is and really can remember how to do worse. If you're wondering how credit default swaps on U.S. government debt can possibly be a bank sector signal, I went over all of that in yesterday's video, and that's the one we've got linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.